India's leading indices Nifty 50, Bank Nifty and Sensex. The Indian stock market boasts prominent indices like the Nifty 50, Bank Nifty and Sensex. These indices serve as barometers of the stock market's performance. They reflect investor sentiment and the overall health of the Indian economy. Understanding these indices is crucial for both seasoned and novice investors. The Nifty 50, managed by the National Stock Exchange of India, NSE, comprises 50 of India's largest and most liquid companies. It represents approximately 85% of the total free-float market capitalization of the NSE. The Bank Nifty, as its name suggests, tracks the performance of 12 leading banking stocks listed on the NSE. This index is particularly significant given the banking sector's substantial contribution to India's GDP. The Sensex, created by the Bombay Stock Exchange, BSE, is India's oldest stock market index. It comprises 30 well-established and financially sound companies listed on the BSE, representing diverse sectors of the Indian economy. Their importance in the Indian financial landscape. These indices play a pivotal role in shaping India's financial landscape. The Nifty 50, Bank Nifty, and Sensex serve as benchmarks for investors to assess market movements and make informed investment decisions. They provide valuable insights into the performance of specific sectors and the overall economy. The performance of these indices influences investor confidence, both domestic and foreign. A strong performance in these indices often attracts foreign investments, boosting the Indian economy. Conversely, a decline in these indices can signal economic concerns and impact investor sentiment. The indices also act as underlying assets for various financial instruments, such as index funds and exchange-traded funds, ETFs. This allows investors to gain exposure to a diversified portfolio of stocks by investing in a single instrument. The transparency and efficiency of these indices contribute to the credibility and stability of the Indian stock market. They provide a fair representation of market movements, enabling investors to make informed decisions based on reliable data. By closely monitoring these indices, investors can gain valuable insights into market trends and make strategic investment choices. A glimpse into their past. The origins of these indices can be traced back to the liberalization of the Indian economy in the early 1990s. The economic reforms introduced during that period led to a surge in stock market activity. The need for reliable benchmarks to track market performance became increasingly apparent. The Sensex, established in 1986, was the first equity index to be introduced in India. It quickly gained popularity as a barometer of the Indian stock market's performance. Following the success of the Sensex, the NSE launched the Nifty 50 in 1996. The Nifty 50, with its broader representation of companies, emerged as another significant benchmark for the Indian stock market. The Bank Nifty, introduced in 2003, catered specifically to the growing interest in the banking sector. The introduction of these indices marked a turning point in the Indian stock market. They provided much-needed transparency and efficiency, attracting domestic and foreign investors. Over the years, these indices have evolved and adapted to the changing dynamics of the Indian economy. The Nifty 50, Bank Nifty, and Sensex are all calculated based on market capitalization-weighted methodologies. This means that companies with larger market capitalizations have a greater influence on the index value. The index value is calculated by taking the sum of the market capitalizations of all constituent companies. This sum is then divided by a divisor, which is adjusted for factors such as stock splits, dividends, and new listings. The divisor ensures that the index value remains consistent despite corporate actions that may affect the market capitalization of individual companies. The real-time calculation of these indices provides investors with up-to-date information on market movements. The selection criteria for companies included in these indices are rigorous and transparent, typically considering factors such as market capitalization, liquidity, trading volume, and financial performance. This ensures that only the most eligible companies are included in the index, representing the overall health of the market. Indices play a crucial role in investment strategies, particularly for passive investors. Index funds and ETFs aim to replicate the performance of a specific index, such as the Nifty 50 or the Sensex. By investing in these funds, investors gain exposure to a diversified portfolio of stocks without having to select individual stocks. This approach is particularly beneficial for investors who prefer a hands-off approach to investing. Index funds and ETFs are known for their low expense ratios compared to actively managed funds. This is because they do not require the same level of research and analysis as actively managed funds. Additionally, indices serve as benchmarks for evaluating the performance of actively managed funds. Investors can compare the returns of their actively managed funds to the relevant index to assess the fund manager's skill in outperforming the market. Indices also provide insights into sector-specific performance. For instance, investors interested in the banking sector can track the performance of the Bank Nifty to gauge the sector's overall health and identify potential investment opportunities. The Indian stock market has witnessed significant growth over the past few decades, driven by factors such as economic liberalization, technological advancements, and a growing middle class. The Nifty 50, Bank Nifty, and Sensex have reflected this growth, reaching new heights in recent years. As India continues on its growth trajectory, its stock market is expected to attract further investments from both domestic and foreign investors. The Indian government's focus on economic reforms and infrastructure development is expected to create a favorable environment for businesses to thrive, further boosting the stock market. The increasing adoption of technology and digitalization is also expected to create new opportunities for growth and innovation, attracting investors to the Indian market. The Nifty 50, Bank Nifty, and Sensex are well positioned to benefit from these positive trends. As India's leading stock market indices, they will continue to serve as barometers of the country's economic progress. By understanding these indices and their significance, investors can gain valuable insights into the Indian stock market and make informed investment decisions.